Welcome to Thoughts in the Market. I'm Andrew Sheets, Chief Cross-Asset Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about trends across the global investment landscape and how we put those ideas together. It's Friday, July 15th at 4 p.m. in London. One of the big stories this week was, once again, a high reading of U.S. inflation that came in above economists' expectations. If that sounds familiar, it's because it is. U.S. consumer price inflation was also higher than expected in June, May, and April. These upside surprises to inflation create a trio of problems. First, investors will feel more confident if inflation starts coming down, and this is yet another month where that isn't the case. Second, the Fed has been adamant that it will keep raising interest rates until inflation moderates, which means that more rate hikes are likely coming. And third, this sets up a real predicament. The Fed wants to bring inflation down and sees this as key to its credibility, but raising rates today won't do much for inflation over the short term. That creates additional uncertainty. Markets are responding to that uncertainty by raising expectations of how much the Fed will increase rates in the near term, while simultaneously becoming more worried about medium-term growth and lowering expectation of rates over the long term. That has inverted the yield curve, something that, while rare, has historically signaled high odds of a recession. What's notable, however, is that while there is intense focus on the concerns and negative surprises from the current rate of inflation, the longer-term picture is arguably getting better. One can observe expected rates of inflation over the next 5, 10, or 30 years, also called inflation break-evens. Those expectations have been falling rapidly over the last 2 months. In the U.S., markets currently see U.S. consumer price inflation to average about 2.35% over the next decade. That is more than 0.5% lower than where that same estimate was just 2 months ago, and it's similar to where these expectations were in March of 2021. 2.35% is also pretty close to the Fed's inflation target. Markets do not see inflation accelerating in an uncontrolled manner over the long term. For investors, think of this dynamic as one of short-term pain but longer-term gains. Near-term, high inflation and uncertainty of when it will decline could keep the Fed cautious and argues against buying the dip. But looking further out, the market is giving encouraging signs that inflation is a manageable problem and that central bank actions are working at addressing it. In the autumn, we could see a situation where the inflation data is moderating while long-term inflation expectations confirm that that moderation continues. For markets and for central banks, that would be much more helpful. Thanks for listening. Subscribe to Thoughts of the Market on Apple Podcasts or wherever you listen, and leave us a review. We'd love to hear from you.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.